Okay, hi everyone. This is going to be the problems video for chapter 14. So it looks like we have, one, two, three, four, five, six different problems we're going to go through here. Okay, with that said, let's start here with number one. They're saying the management of a corporation is considering an investment with the following cash flows. All right, so it looks like in year one and year two, there's going to be 15,000 and 8,000. And then in also those years 1, 2 through 10, we're going to have some cash inflows. Right? So what they're asking us to do here is determine the payback period of the investment. And for 2, it says, would the payback period be affected if the cash inflow in the last year were several times as large? Okay, so what we can kind of do here, right, we could plug in an equation form, but let's just kind of map it out over here. So we'll have years 1 through 10. And then, right, we have our investment. We have the associated cash inflow. And then let's make a third column here for unrecovered investment. So it looks like it's 15,000, 8,000, and then 1,000. Just copy this over. Okay, so if you think about it, right, at the end of year one, we had an outflow of 15, but we had an inflow of 1,000, right? So we're looking at 14,000 there. But then from that, right, we have an additional 8,000, but we have an inflow of 2,000. Right, from there we have an inflow of 2,500, another inflow of 4,000, 8,500. Right, we'll just keep subtracting it there, 2,500. Oops. Negative 2,500. So this is the year, right, we're going to hit the payback, right, in year 7. So it's kind of the magic year here. Now, the thing with this, right, is these right here, right, these inflows, they change from year to year, right? It's not like it's 1,000. 1,000, 1,000, 1,000. That would be kind of a uniform or even cash inflows. These are uneven cash inflows. Just a different amount. It's not the same amount. So the idea with this is, right, we know that we're going to have that modified equation, right? So it's going to be the year up to the year of payback. So we hit it in 7, so the year up to that is 6. Right, plus what we're going to do here, we have to put in the numerator the unrecovered investment at the beginning of the year of payback, right? So going into year 7 here, we still have 2,500 bucks left. And then you put in the denominator there the amount of payment that you get in the year that it's paid off. Right, 5,000. So when you run the math on that, right, it's going to be 6.5 years is our payback period. Okay, so that was 1. For 2, it said, would the payback period be affected if the cash inflow in the last year were several times as large? So what they're saying here is if this guy, right, in the last year, year 10, if this was several times as large, let's just say it was $6,000. Now, the idea with that is it's not going to matter, right? Would it be affected? No, it's not going to be affected. Look, we get the payback here in year 7. You could double this, you could triple it. By the time we get in year 10, we're way past the payback period. Anything past 6.5 years, we're already paid back, right? So the answer for this one is going to be no, right? It's not going to be affected. Okay, nothing too tough there. Let's move on to E14.2 here. Okay, so let me zoom in here so I can read this. It says the management of a company is considering purchasing a machine, and it would reduce operating costs by virtue of buying this machine by $7,000 per year. At the end of the machine's 5-year life, it will have a $0 salvage value. Looks like the company's rate of return, 12%. Okay. What they want us to do here is determine the net present value of the investment in the machine. And then for 2, they're saying, what is the difference between the total undiscounted cash inflows and the cash outflows over the entire life of the machine? Okay, so for 1, let's focus on that first. Right, so we know the net present value is going to be the difference between the cash inflows and the outflows of a project. The main goal is we're trying to have positive net present value. That means we get more cash than we spend. And again, we're present valuing it. We're putting it into today's dollars. Okay, so with this, let's do, right, if we think about what's going on, right, we have right now, and then we're going to have years 1 through 5. Okay, and then let me kind of stretch this out, right? We're going to have, we purchase the machine, right? So right now, that's a negative 27,000 cash flow, right? You spend that amount on the machine. That's in, right now. Then we say, right, the next thing we got to be aware of is we said that it reduces operating costs. They're telling us, what, $7,000 a year, right? $7,000 in years 1 through 5. So if we're going to just figure out the total cash flows, right, if we were to just run these down just to get a total amount to start with here, all right, we're going to have the negative 27, and we're going to have the 7. All right, next thing we got to do is multiply these times the discount factor. Now here's the deal, right? Anything today, $1 today, is worth $1 today. So the present value factor for $1 today is 1.0, right? Now what we have to be aware of, however, is what goes right here, right? How do we figure that out? So we got to use the time value of money table. So let me pull that up. Right, so a couple things here just before I take it through. So this is for years 1 through 5. So right in year 1, year 2, year 3, year 4, and year 5. Each year, right, we save $7,000. So that's called an annuity. Right, it's a steady stream of payments for the same amount So what's going on here, right? The number of years, we have 5 years. In the interest rate here, we said our rate of return is 12%. So when we figure out, right, the discount factor here, if we were to use the tables on this, right, we'd go to, nope, we don't want to use this one, present value of $1. We want to use the present value of an annuity. And we said the interest rate here is 12%. And we said for 5 years, right? So 1, 2, 3, 4, 5. We're looking at this 3.605, okay? So that's the number that we're going to put in here, 3.605. Now, with that, we'll be able to figure out our present value. All right, so we'll do the 27,000, times the 1. We'll do the 7,000 times the 3.605. That's going to give us 25,000. Now, what we're going to do here, right, is we're going to figure out our net present value. Right, it's going to be this 27,000, right, our outflows minus our inflows, right? So the net present value here is negative 1,765. We don't want to make this money, right? We're going to spend more money than we are going to get money in, right? It's going to cost us 27, but we're only going to get 25. So you don't want to make this investment here. Let's look at 2. Right, 2 says, what is the difference between the total undiscounted cash inflows and the cash outflows over the entire life of the machine? Okay, so we're looking at undiscounted, right? When they say discounted, they mean put into today's value. We shrink it into today's value. If we don't do that, right, if we just look at the nominal amounts, we don't account for the time value of money. So let's kind of work that out here, right? We would have our annual cost savings. We would have our initial investment. And then we could figure out our net cash flow. All right, so we'll put cash flow here, right? We know that every year we're going to save $7,000. Now, that's going to be for 5 years. Right, so in total there, we're going to save $35,000. Right, our initial investment is 27 grand. We do that in 1 year, like year 1, right? So the total there, is going to be negative 27,000. Right, so the net cash flow between those is $8,000. So this is basically what it's showing, right? Whenever you present value it, right, you put it in today's dollars, you're going to say, no, I don't want to make the investment. Basically the outflows are going to be greater than the inflows. It looks, it's not good, right? And this is a more accurate way of doing it if we, put the money in today's dollars. If we didn't, right, so this is called discounting. Right, we take something in the future, that's 7,000, and we shrink it into today's dollars, right? What all of these payments are going to be, right? If we shrunk that annuity down, it's roughly like 25,000, right, in today's dollars. If we didn't do this, right, if we didn't shrink it down, we just looked at it like 7, 7, 7, 5 sevens, right, that's discounted, right? So we just look at the raw number. It looks like 35, right? We spend 27. Oh, that's a good deal, right? Yes, we should make the investment. The problem is, right, this is kind of not as accurate as up here. Discounting it's a more accurate way to do it. So it's just a good exercise to show you that, the net present value, and then also showing why it's important. Let's move on to exercise 14.3 here. Okay, so it says we have a donut shop and they're investigating the purchase of a new donut making machine, right? So they're looking to buy this machine. New machine, essentially what they're telling us here, it would reduce the amount of part-time help needed at a cost savings of $3,800 per year. All right, so we'll save $3,800 per year. In addition, the new machine would allow the company to produce one new style of donut, resulting in the sale of 1,000 more donuts per year. So we're saving money and we're making money. Looks like we have a contribution margin of $1.20 per dozen of donuts sold, and the new machine would have a 6-year life. Okay, so let's look at this. They're asking us 4 items here to do. The first one says, right, what would be the total annual cash inflows associated with the new machine for capital budgeting purposes? Okay, so we got 1. They want to know what are the inflows from it. All right, so first off, they're telling us that we're going to have annual savings from part-time help, right? We'll save on that labor cost, right? So each year, we don't have to hire as many employees. We save $3,800 there per year. Likewise, right, one of the things here, we're going to have an added contribution margin from more sales, right? So what's going on here, right? They say by virtue of buying this, we're going to have 1,000 more donuts we make with a contribution margin of $1.20 a donut. All right, so this is going to be $1.20 times the additional $1,000. So when we look at our annual cash inflows, this thing, if we buy the new donut machine, we're going to get $5,000 a year in annual cash inflows. All right, 2, it says what discount factor should be used to compute the new machine's internal rate of return. Okay. So for this, right, we have the internal rate of return. That's going to equal your investment required over your annual cash inflow. Okay, so we know here, right, that our annual cash inflow is $5,000. We just calculated that. And then our investment, right, let's go over and see. It looks like the thing is going to cost us $18,600. All right, when we do the math on that, right, 18,600 divided by 5,000, we're looking at 3.720. Right, now that's not the answer by itself. What we have to do here now is use the present value tables to back into the discount rate. So let me pull those up here. So we have, what was the number? 3.720. That's the starting point with it. Okay, so what we're going to do here, this is a little bit tricky. I had to pause it for a second to look at it here. So we know in this case, right, if we go back to the facts, it says the machine has a 6-year useful life, right? So we're going to do here the annuity because it's 6 years every year. And then what you do is you shoot across, right, until you find that 3.720. Right, now here's the problem with it, right? They aren't explicitly giving you the 3.720. This is where I had to pause to kind of look at it. What you have to do then is pick the closest item to it, right? So the 3.68 that's closest to the 3.72 without exceeding it. So once you hit that, just imagine it said 3.720 right here. You shoot up, and that will take you to 16%, right? So based off this right here, you go to the 6 period line, right? So you go down to 6, right? And the reason we do that because 6-year useful life. And then you go across, you run across that till you get to the closest number to 3.720, right? In this, it was like 3.68. But normally, right, if we had a homework or something on it or an exam question, it would match exactly, right? So that was the closest number without exceeding. You shoot up, right? And then that gives you your internal rate of return there, right? So the nearest whole percent, the internal rate of return is going to be 16%. So the idea here when it says what discount factor should be used to compute the new machine's internal rate of return, the answer there is going to be the internal rate of return is 16%. That's for 2 and 3. So with that, right, it says, in addition to the data given previously, it says assume that the machine will have a salvage value of 91.25 at the end of the 6 years. Under those conditions, what is the internal rate of return to the nearest whole percent? Hint, you may find it helpful to use the net present value approach. Find the discount rate that will cause the net present value to be closest to 0. Okay, so the internal rate of return is another way of saying what rate of return sets the net present value to 0. So let's kind of map this out here for number 4. Oops. All right, so we will have now, right, we'll have years 1 through 6, and then we'll have stuff that happens in year 6. And in year 1, right, we purchase the machine. That's going to be $18,600 of an outflow, right? We know that it's going to reduce our part-time help, right? We'll have those savings of $3,800 per year, as well as, right, we'll have the added contribution margin per year of $1,200. And at the back end, right, in year 6, we'll have the salvage value of the machine. I believe they said that was what, 91.25, right? So that will give us our total cash flows to begin with, right? Let's just sum these. All right, just copying that formula. Right, now what we do is we have to find the discount factor. And a couple of different things on this, right? We said this guy right here is easy, right? The dollar today is worth $1 today. So let's do that, it will give us the present value. All right, so that'll be $1 times negative 18.6. Now what we have to do is find these guys right here. And with it, right, this guy right here, since it's 6 years, is going to be an annuity. And this guy right here, because it's a one-time thing, we're going to use the present value of $1 table. All right, and we know, let's think about this, our interest rate. Let's go back to the facts here. Let's see what's going on here, the discount factor. So it says as a reference, what's the new to the nearest whole percent? Okay, so here's what's going on with it. This guy right here, at the end of the day, right, our net present value has to be 0, right? Because we're trying to find the internal rate of return, which is really saying what is the percentage or the discount factor we use, right? So we know the we know the N in each of them. Right, so it's going to be 6 years, but this guy is kind of the mystery here. And what you would do is, right, why you can't use this right here to figure out what the discount factor is, what the and back into it, and then to kind of go over and shoot up, and that will give you the percent that you plug in. You can't do it because you don't have a uniform amount of cash flows. I'm sorry, you don't have a uniform amount of annual cash inflows. In other words, it differs in the last year, right? You got this 91.25 in the last year. Years 1 through 6 have roughly 5,000 each year, but in the last year you have the 5,000 and the 91.25. So that kind of bans you from using this. You can't have a flat uniform amount for the denominator. So what you would do, right, is you would play around with, you could kind of fiddle with it. You have to get it ultimately where down here, these two, when you take the 18.6 plus these two, come to 0. So what would happen here is you would use the discount factor. There'd be trial and error, right, of 3.167, 0.303. And then we would multiply it down, right, 15,835. And let's just round this up to 2765 there. Right, so that gets you to 0 when you do the 18, that, and that. So what it would be then, right, the internal rate of return, the interest rate, it would be 22% is the internal rate of return. So this guy, right, would be 22. And we can check this. Right, if we go into the present value tables, 22%, 1, 2, 3, 4, 5, 6, 0.303 for the present value of $1. With the annuity, right, this is the annuity table, we got 22%, 1, 2, 3, 4, 5, 6, 3.167. So that's where we got the 0.303, 3.167. Okay? All right, let's move on to exercise 14.5 here. For this one, they're saying information for 4 investments is given below, A, B, C, and D. can you please use the profitability index for each investment, rank the proposals in terms of preference, right? So the idea with this is we're trying to compare different investments. We can't just use the net present value. The reason being is there's like different cash flows for the initial investment. So it's not really a good, accurate way to compare them. However, what we can do is use the profitability index. In other words, convert the net present value over in a way to compare them, right? So if we were to, and let's build it out over here, calculate this profitability index. Let's look at each proposal. Right, we got A, B, C, and D. We will have the present value of the inflows on them. Right, so 126, 138, so 126, 138, 105, 160. Then we're going to have, in this case, the investment required. Right, so that's that top part right there. Right, so it's 90,000, 100,000, 70,000, 120. And then to figure out the profitability index, right, what we're going to do is basically divide it, right, for each of them. Right, so if we take the 126 divided by the 90, 1.4, take the 138 divided by 100, 1.38, take the 105 divided by the 70, 1.5, take the 160 divided by the 120, 1.3 repeating. Right, so that was one right there. It says compute the profitability index for each one. The second one says rank them. Right, so the idea with this, when you rank, right, the higher the profitability index is the better. Right, so it's kind of like, you know, at the end of Mario Kart when you win the race or whatever, right? The person who's on the highest pedestal in the middle, they're racer number one, right? So the highest one here, if we look at it, right, it's the 1.5. Right, so that's number one. That's investment C, right? They come in first place. That's the best. Second place is going to be this 1.4. Right, that's going to be A. 1.4. Third place, the 1.38. That was B. And then finally here we got D. All right, that was what? 1.33 repeating. Right, so first place, second place, third, and then fourth. Okay? All right, let's look at another problem. Right, it says the management of a company is considering the purchase of a automated bottling machine for 120 grand. All right, it says the machine would replace an old piece of equipment that costs $30,000 per year to operate. And then it says the new machine, right, would cost $12,000 per year to operate. Oops. So I'm just trying to keep the colors here, one for old, yellow for new. And it says the old machine currently is in use, is fully depreciated, and could be sold for a salvage value of $40,000. It said the new machine would have a useful life of 10 years with no salvage value. All right, so let's go through and see what they're looking for here. The first one, it says, what is the annual depreciation expense associated with the new machine? Okay, so the idea with this, right, for one, if we look at the cost, right, it's $1.20. And how long is it going to last? 10 years? Right, so our annual depreciation expense, right, we're going to have $12,000 depreciation expense each year. Okay? Next one, for 2, they're saying, what is the annual incremental net operating income provided by the new bottling machine? All right, so this one, maybe it's easier to type this out here. Let me zoom out a little bit. So basically the operating cost each year of the old machine, right? The old guy, the green one, that is, let's see, $30,000 per year. All right. Now we're going to subtract from that the operating cost of the new machine, right? So the new machine cost us $12,000 a year, but remember, we also, in that case, get depreciation each year on the new machine of $12,000. Right, so basically the idea with this, let me put that in there, right? Our annual incremental net operating income by virtue of buying the new machine, right, we're going to have $30,000 of an expense minus 12 minus 12. We're looking at $6,000 of annual incremental operating income. In other words, right, by virtue of buying this new machine, between what it's going to save us in operations as well as the annual depreciation, we're going to have $6,000 more of operating income each year. All right, so we've done 1, we've done 2. Let's look at 3. They want to know, what is the initial investment associated with this project that should be used for calculating the simple rate of return? Okay, so in this case, right, for purposes of the simple rate of return, remember we said that there's ways that you have to modify both the numerator and the denominator? Well, in this case, right, our initial investment, what it's going to be is the cost of that machine. Let's see here, 120,000. And then what we're going to back out from that, right, is the salvage value, what we could sell it for. Right, 40,000. All right, so it's really like our investment in this case. Cost us 120, we're going to get 40 at the end. It's really like it cost us, our initial investment is $80,000. So with that, right, they want to know, what is the simple rate of return? Right, so the simple rate of return, the formula for that is going to be your annual incremental net income or net operating income divided by your initial investment. Right, so we've already done our annual net operating income, and we've already solved for our initial investment. Right, so in this case we'll have 6,000 divided by 80,000. We're looking at a simple rate of return here of 7.5%. All right, let's go do problem 1417. Okay, so this one, it's kind of a combination of different items here. So it says, this individual is a division manager of a company. His annual pay raises are determined by his division's return on investment, which has been above 20% the last 3 years. They're considering a capital budgeting project that would require a $3,500,000 investment in equipment. Looks like it's going to have a useful life of 5 years, no salvage value. The discount rate is 16%, and it looks like it would provide net operating income each year for the 5 years as follows. Right, so we'll have our sales minus our variable expenses gets us our contribution margin. We back out our fixed expenses that get us to our net operating income. All right, for this, right, they're giving us 4 different things here. The first one they want is the net present value. All right, so for one, they want net present value. So what we're going to do here, right, we can build this out. Let's see on it. All right, so we will have here now, and then we'll have years 1 through 5. Right, now in the current year, we purchase the machine. Right, and they're telling us the year that it's a $3.5 million investment. Likewise, right, if we look at the facts here, it looks like every year we're going to have sales, in this case, inflows of $3,400,000. Variable expenses each year, so these are outflows of $1,600,000. We're going to have out-of-pocket expenses, in this case, let's see, every year of $700,000. And depreciation, we're not going to use that, right? That's a non-cash item. So that's going to be our cash flows. Let's do our total cash flows then. Right, so we're looking at $3,500,000 there. We're looking at $1,100,000. What we then would do, right, is multiply that times the discount factor. Right, now this guy is going to be $1. This guy, right, if we were to use the tables for it, it's going to be 3.274. Right, so that's with an I and an N. Looks like here our discount rate is 16%. And then the number of periods, right, is 5. So if we use this information, went to the table, it would be 3.274. That'll give us the present value. right? If we take and multiply it, 1 times that amount, and then the 3.274. Now from that, we can find our net present value, right? The 3.5, our outflows minus our inflows, right? This looks like a winner, right? The reason is it's positive. Positive for net present value is a good thing, right? That means your inflows are greater than your outflows. All right, so that was 1 there when we did net present value. Next, they want us to do the internal rate of return. Okay, so for this, right, the internal rate of return, right, that's going to equal the factor that we're going to get is our investment over our annual net cash inflow. Right, so with this, all right, so if we plug that in, right, that's going to be the 3.5 from up here over the, right, so that's the initial investment. And it looks like here our annual net cash inflows, right, 3.5 are the 1.1. Right, we do the math on that. We're looking at a factor here of 3.182. All right, so that's 2. Finally here, they want the simple rate of return. That's going to be just our annual incremental operating income over our initial investment. All right, our initial investment here we know is 3.5. And our annual operating income, what we have to do here for this, if we look at it, looks like it's going to be 400,000 from right there. Right? You do the math on that, you're looking at 11.4%. Right? So that's your simple rate of return is 11.4. Your factor for your internal rate of return is 3.182. When you go to the present value tables, right, if you were to look at those, you go to the 5-period line because it's 5 years. The closest number to that is going to be 3.199. Right, when you hit that amount, so you go down 5 periods, you go over, the closest thing without or the closest amount to it is 3.199, and then you shoot up, right, you're looking at 17% for the internal rate of return. So again, that was just a summary item there that ran through some of the calculations that we've done.